Does anyone have any questions? Or I guess that's what we would do, is open that up now to anyone who might have a question.
There is one question in the chat, and then you may find a couple of questions in the Q&A as others perhaps will begin to type their questions in.
Okay, I think that question in the chat looks to me like, Osmar, you probably have a good
yeah, so let's see, there's a few. I'll answer Matt's first from earlier. The question is, where do you start when you want to learn more about mutual funds and compound interest? So Matt, I hope you're still on the call. It looks like you are. I'm going to share my screen briefly to show you. Compound interest is a beautiful thing. There's many materials out there that you can read, and I would highly encourage you to do so. I want to show you the mathematics behind compound interest really quickly. If you were to invest $1,000 a month and you were to obtain, I'm going to say 6%. So this is the interest divided by the year, or the months in this case. So 0.5% per month compounding over that 30-year period, or 360 months, you would actually end up investing a total of $360,000, and your total return or interest growth is 650. If you were to bump this rate of return from 6 to 8%, so here's the difference, you would actually end up still investing $360,000, but notice that you actually earned $1.1 million, having given you a total of $1.5 million. Compounding is an awesome thing. The more time that you give it, the better off you'll be. There's a lot of future value calculators out online that you can access to learn more about it. I encourage you to do so. The second question, in the case of the mutual fund, I use a program called Morningstar. It's a free program that you can use, and it rates each mutual fund. Something to look at is the star rating. Anything 3-4 stars and above is good. I would invest in those. Anything below that, I'd be cautious. There's some underlying factors in those that are a little bit more riskier. So 3, 4, 5 star, I would invest. I always like to look at the history of the fund. What has it done year over year? So you can look at the return. I'm not going to dig into that, but Morningstar, find a mutual fund that fits the allocation that you would want to model. And then last thing I'll say, and then I'll be quiet. Can you guys still see my screen okay? Can you see the quilt that I'm showing? Okay, this right here exemplifies diversification. It is very important to diversify. If you notice the middle, the middle part of the quilt, I call it, is white, right? Diversified portfolios. Those show a better stability over time. This is a time frame from 2006 to 2020, and it shows you what it did. A compounded interest rate of 6.3%, and you only had to take a degree of risk of 9.7. Whereas if you were to only invest, let's say in Walmart, that is a large cap investment. It's a stock. So each year, if you follow this blue, you see what it does. It goes down, it goes up, it fluctuates a lot more. Yes, the compounded rate of return is 9.9%, which is better than 6.3. But the degree of risk that you took to get there is 5.1. I'm sorry, excuse me, 15.1. So that just means that it fluctuates more, and you want to be careful with those types of investments. Steady Yeti, diversify, and keep, invest over a long period of time, and you're going to do all right. I think I covered most of the answers. Let's see, there's one more while I'm on this, and then I'll send it over to you, Cynthia. I believe it was. Let's see, who was it that asked me that question? Grant, you asked me about the FIRE movement. It's interesting, the younger generation does want to retire in their 30s, 40s. I'm not saying that it's not realistic to do so, but you would have to sacrifice significantly in your 20s and early 30s to be able to do so. The article you sent me said something about 75% of your income being saved. Yeah, I would argue that, or maybe even more. You would actually have to take a lot more risk. So it's not out of the question. It just would take a lot of discipline to be able to do that. So those are my thoughts. Hopefully answer the questions, and Cynthia, I'll send it back to you.
And I would say that too, because I looked at that link as well. You know, how much experience do you want to give up? A lot of times I talk to my daughter and grandchildren, and, you know, she's always said, you know, I want my children to remember the experiences that we had. Well, if you're saving 75% of your income, you're not going to have a lot of experiences. You know, because there's just not going to be that to be there. Now, when you're 45, in your mid 40s, you can retire and you might get to have a lot of experiences, but you have to really weigh in the balance what's more important, you know, and what you want to do. You can still save enough to have a great retirement and just work a little bit longer. That's just, you know, that's up to an individual to determine what their risk aversion is, and what their priorities are. And so that's what I would say for that. I did see a question that was asking, and I can definitely speak to this one, about what does an umbrella policy cover? An umbrella policy is a pretty neat policy. Umbrella policies sit on top of your other insurance policies. So if you had a homeowner's policy and an auto policy, an umbrella policy is going to sit on top of that for the liability portion of those policies. So when I talked about having that Arkansas minimum, say you had limits. Now an umbrella policy is going to want you to carry higher limits. Let's say you had an auto policy with liability limits of 100,000, 300,000. So in other words, if you're in an accident, your policy would pay up to 100,000 per person, 300,000 per accident, but something just really bad happens. People are injured, and maybe even there's a fatality. Maybe there's a lawsuit that comes after that, and you had $1 million umbrella policy sitting on top of that auto policy. Then if there was a lawsuit and say a court awarded someone $500,000, you know, above what your auto insurance policy paid, that umbrella policy would come down and pick up that and cover that for you, and would pay that for you. So that's where an umbrella policy can be very important when it comes to protecting liability, protecting your reputation, protecting you against those things that happen that are really, no one imagines, you know, thinking about things like that happening, but sometimes they do. And so, especially if, and possibly no one that's in this seminar would have this, if you own, like, say, rental property or something like that, and you have renters who are living in your property, things like that become even more important over time. I have seen some who, while they were going to school, would buy a duplex. So they would have one side of the duplex is rented out to someone while they're living, the owner is living in the other side of the duplex. So you could have things that would happen there, you know, that might be liability issues that would, again, having a personal umbrella policy in place would be very important. And those are usually not very expensive policies either to add on top of your auto and your homeowner's policy. Let's see. I see a question in here, and Osmar, I think that might be one that you could talk about life insurance. Do you see that one?
Oh, yes, here we go. We'll turn around. Yes, okay. Yeah, so when we're doing life insurance planning, the first thing you want to consider is what is the amount of death benefit that you need, and lock that in with term first, always, because you can always convert that later. So once you run through that calculation, I said earlier, debt, income, and education expense, let's say that comes up to be $1 million. Get a $1 million term policy. It's going to be very cost effective. I've seen, you know, premiums of $30 to $50 a month for that kind of coverage, which is great. When the budget allows, yes, I would recommend that you have permanent life insurance as a part of your asset accumulation buildup. because permanent life insurance can do several things for you in the future. Number one, you can access the cash value, or recently it changed to accumulated value to be more fancy. You can access that for the purposes of retirement. Should you become permanently disabled, most policies have a rider on them that will pay itself until a designated period of time. If you go into a long-term care event, yes, there are some policies now that allow you to access the death benefit while you're living if you go into a long-term care event. So there's a multitude of benefits that it brings to the table. And then the last one is the death benefit passes on to the next generation tax-free. So huge advantages of having that if the budget allows for you to do so. Generally, I don't recommend doing more than 5% of your gross income in premiums per year. That's a good rule of thumb. So that's let's see. I believe I answered all of your questions. Okay.
I see another question on here, and Osmar, you can feel free to chime in on this one as well. But reading through the question, part of it talks about wanting to get married while they're in school, and ask if there are any common financial mistakes that young couples make that they should watch out for. Or do you have any general advice on that particular topic? And I'm going to refer back to, what I said earlier when I was talking about making sure that you live within your means. Be careful about overextending yourself. It's so easy to get credit cards and put a lot of money on credit cards and find yourself then deep in debt and struggling to get out from under that, and then having to spend a number of years trying to get out from under that so that you have the ability then to purchase a home or something else that you want to. So I would advise you to be very careful about your expenses and plan for your expenses and the things that you want to do, and try to stay away from a lot of that credit card debt, because the interest that you pay on those is not like a 2 or 3% home loan. You're going to pay upwards of 20, 25, and 30%. And the way that the interest is compounded on credit cards, you can easily get into a position where you're making a monthly payment, but you're not going anywhere with it, and you're not being able to pay down that debt that you've built up. So be very careful about making those kind of decisions and getting into debt over your head. Now, Osmar, if you want to chime in on anything with that, that would be great.
Yeah, I would echo that. Absolutely. Stay away from bad debt. If you have to take out student loans for school, make sure if they're private, shop around, get the best interest possible. If they're federally backed, I'm not. If you have to forgive me for the graduate program, I'm not sure if you can get subsidized loans or not. And Angela, Cynthia, you might know about that. You cannot. Okay.
Oh, I don't know.
Oh, you don't
I'm
know?
not sure. I think you.
For graduate?
I think you can. Like, I think I had that
Okay.
as a graduate student.
Okay. So if you're able to get the graduate, Grant says, I don't think so. Okay. Explore that option. If it is something that you can do, then go that route. If not, just stick to the lowest interest loan possible. That's really the best advice that I can give you there. And come up with the plan too. Before you take that loan, have a plan of how you're going to pay that back. When you graduate and start your career, do your research, as Cynthia was saying earlier. Do your research. What is the salary that you're going to be able to expect from this occupation you're going to go into, to make sure that you're going to have enough income coming in to pay for to service that debt. I do see another question from Kathleen. What are some companies that sell disability insurance if your employer doesn't offer that? There's a lot of companies that do this. So just to name a few that I work with on a day-to-day basis, so Northwestern Mutual, Mass Mutual, New York Life, let's see, who else? Guardian, Mutual of Omaha, Prudential, Principal, those are all good companies. I think the main thing to look at whenever you're doing purchasing a disability policy is to look at the definition of disability. Some contracts are written specifically to your occupation. So if you're not able to do your occupation and you become disabled, you start to receive a benefit. Others are not designed that way. It's any occupation. So if you're able to perform any occupation other than your own occupation, sometimes it won't pay. And so you want to be mindful of what contract you're signing up for. Another key word or words in a disability contract are and versus or. So I'll give you an example. The disability contract could read, unable to perform the duties of X occupation and lost the ability to work more than 20 hours or something like that, versus unable to perform the activities of X occupation or lost the ability to do more than 20 hours. So that slight different, or that slight change in verbiage could mean whether or not you're actually going to get the benefit. So I would be very mindful of that. I would even encourage you to go as far as having an attorney look at the contract with you so you make sure that you understand it, or work with the advisor or a disability agent that you trust and you know is going to do right by you. Hopefully that answers your question, Kathleen. And there's one more from Jose. Oh, hey, Jose. We've been coordinating, I think.
Before we do that, when we had one that came in earlier that I believe Matt had entered, and I think this is something that's really good if we can bring this up and then we can speak to what Jose asked. When you're interviewing for a job, what are some key concepts to consider? And what they said, especially if you have one option that offers a higher salary, the other option is a lower salary that has a better benefit package. So what are some important points, you know, that we should key on to help make a decision in a case like that?
Do you want to go first on that?
No, go ahead.
Okay. So if the benefit package, I would look at what is the content of the benefit package. So some benefit packages might include employer stock options, and generally those are given to you at a discount. So I would look at, okay, if I've got the opportunity to jump into that, you know, does the reward, you know, is it going to benefit me? Another option that you might have is to participate in a different plan than just the 401k. If you're a key employee, sometimes businesses or corporations want to reward you in excess of, for example, just the 401k plan. So I would look at that. A lot of times, though, what that means is that compensation, that extra benefit, will be captive for a certain amount of time until you're vested. That'll be a term that you'll probably hear. So I would just look at the options. You know, will you be at this company for an extended period of time where you're going to be vested in those benefits? If so, you know, yeah, I would take that versus probably the salary, just because it's going to be more advantageous to you long term. And then another variable, very important variable that you need to consider is, can I live off of maybe a lesser salary so that I can take advantage of these benefits? So you just have to weigh your options there.
Yeah, a lot of that is going to depend on too, you know, the type of position it is, because sometimes you start at a certain position, but then the benefit options, you know, get better the longer you're with the company. So you have to look at, you know, are you locking yourself into it may be a little bit lower salary and a pretty good benefit package, but does it change? So are there any options that are going to grow with the job? So that's another idea too.
Absolutely.
Then we have Jose's question, and I think that's a really good question. I want to hear you answer that. My experience has been with property and casualty, so it's protecting your homes, protecting your cars. I know you deal a lot with the disability and the life insurance and the investments portion. So I see where Jose has asked on the permanent life insurance that you said the death benefit can go to the family tax-free. What happens to the cash value buildup?
So there's whole life insurance, and so what happens is the death benefit is paid out, not the cash value. The cash value is for you to utilize while you're living. So the greater of the two goes on to the family. So in essence, the cash value disappears, but the death benefit is greater than, or should be greater than, the cash value, unless you reach age 100, at which point the two are equal. Now, if you have a universal type of policy, it's a different structure than just a whole life chassis. In some of those policies, you would be able to get both the death benefit and the cash value. Although there's some intricacies of that type of policy that are different. They may require higher premium later on in life. So I just would be careful with that. But there are those that offer that opportunity. And also, I want to make something clear on the tax-free part. If you as an individual own the policy and you're paying the premiums with, after tax, it's not paid from your company or anything like that, it will be tax-free. But if you're a business owner, for example, or if your business, your employer provides it to you and they pay for it, anything above 50,000 is taxable. So I do want you to keep in mind that in mind. Or again, if your business pays for it and takes the deduction for it, then the benefit is taxable. It's only in the event that you as an individual own it and pay for it that the benefit is tax-free. Great question on that. Thank you for asking that, Jose.
So I think that y'all have pretty much answered the different questions that we have, and looking at our time, we're pretty much about to be out of time. So that's a perfect way to end our session. I appreciate y'all's time. I will say, and one person answered, I typed an answer. One person asked, I typed an answer, but I'll say it out loud. And that is that we will take this recording of our session tonight and post it on the Graduate School's YouTube channel so that they can access this, go back and see it. And access it to get, review some of the information that's been provided. And I hope that if they have questions that you all will be open to receiving some email follow-up as well. So we'll provide that information for them.
Absolutely.
Be more than happy to. Yes.
Awesome. I know that I personally found this very beneficial. I wish I had heard some of this about 25 years ago. But it's never too late, so I'll take in some of these things and appreciate the insights that you all have shared. And so thank you again. And thank you to our participants who joined us this evening as well. So y'all go out and have a great evening, and we'll be in touch again, I'm sure.
Right. Thank you, Angela.
Thank you for having us.
Thank you. Thank you a lot. We appreciate it.